So a multi-step income statement is great because it gives a bunch of different information by breaking down not just the total profitability of the company, but the components of how they arrived there, what their sales were, what their cost of operations were, what other transitory elements affected their income, what portion of their income came from operations that they wish to continue, and what portion came from operations that they are going to discontinue. And we have all these parts. The one big flaw of this, though, is that this example that's on the screen right now is unreasonably small. Like they have an office supplies expense, an office salaries expense, and a depreciation expense for general and administrative. Well, there's probably in real practice a lot of other things that go in there. There's utilities on that administrative office. There's probably property taxes they pay. In real practice, if you report every single line item, you are going to have just a massive, massive income statement. And one option to deal with that size issue is to condense your line items. This is a condensed version of an income statement. As you can see, it's the same number for the bottom line. It's just how they report the individual items. We have selling expenses of 46,000. Well, if we go back to the other income statement, we do see that in fact is the total of the selling expenses that they had. Same thing's true over here for their G&A expenses. It was 45,000. Also the sum that they had when they broke everything down into individual lines. And a big one down here, we have $111,150 of continuing operations before tax as a result of the $32,350 increase that our others had from our operating income. And that number right there, 32,350, is actually the offset of the $42,200 in revenues and gains we had and the $9,850 of others expenses and losses that we had. So they're basically reporting this entire huge green section is just that one line. But you still get all of the big picture levels of profitability, what their gross profit was, their markup from their goods, operating income, their income that was remaining after all core operations were accounted for, income from continuing operations before tax, their total amount of income they had, factoring in not just operations, but things that existed outside of the realm of their operations, so on and so forth. You still have all of the big key performance indicators for profitability over here, but it's a much smaller statement. And for people that just want those big numbers, just the key performance indicators, this is great because they can just go through on a very small document and find the figures that they're looking for. But some people are gonna want to know why. Like what exactly were all these others that we had here that had such a huge increase to our profitability? That's something I would want to know. So how do you have the best of both worlds, where you have a smaller, more manageable income statement, but you provide the information to people that want more detailed information? Well, you put that more detailed information in the notes. So underneath the income statement, you would have notes to the income statement. And in that, that's where you give the breakdown of how you arrived at those numbers, 46,000, 45,000, 32,350. This is the breakdown of how they got to their selling expenses, their G&A expenses, and their total amount of others. And that information is there for people that want to use it to make informed decisions. If somebody was concerned they had a huge one-time spike in their income because of some weird, extraordinary situation that was causing the others, well, they would go to the notes and they would see the biggest chunk of it came from interest income and interest is earned on bonds, etc., which means that is fairly repeatable. They can expect that in the next period. But if somebody didn't care about that, well, then they just have, hey, this is the amount of income we had from continuing operations. So condensing your income statement makes it more manageable to people that just want the big picture key performance indicators while still allowing you to have that more detailed information in your notes to people that care to know the breakdown of how you arrived at certain line items. That is, in my opinion, the best way to go about making an income statement. And the worst way is to have a single step income statement. And the reason being right here is it doesn't classify anything. It just chunks all your increases to profitability, your revenues and your gains, and all of your decreases to profitability, your expenses and your losses together. And looking at it, it's just a big wall of numbers where you have to go through yourself and figure out what was the amount that we got from operating income versus non-operating? What was the total cost we had of things that were related to selling, et cetera? It doesn't give you those key performance measures that help you make decisions in more detail about the company. And look at this thing. We have all our revenues and gains listed at the top. We had $277,000 worth of total revenue and gains. We had, $199,500 worth of total expenses and losses. but we don't have the breakdown of what came from, what came from selling. We'd have to go through and find all of our selling costs. We don't know what our markup was on the goods that we sold. We'd have to go through and find our sales and our COGS, find the difference between those two numbers. So a single step income statement, even though you arrive at the same number as every other one, doesn't give you a user the information as much detail without requiring them to go through and do the calculations themselves.